The tariffs that we initiated on the world started in January 2018, and here we are, the summer of 2019, and I don't see us any closer to a deal. And to your point about that last 10%, it's all about the enforcement, and it's all about the tariffs, which are the most important things. Everything else is really irrelevant when compared to that.
So let's, Mark, assume that we come out of the meeting over the weekend without a hard, firm, signed deal. I don't think a lot of people expect that. But maybe a de-escalation of tensions, maybe an extension or a moving back of the goalposts. Will that be enough to satisfy the markets?
Tyler, for a time being anyway, I think a win coming out of this weekend, given what you said, which I agree with, which is little expectation we get any kind of firm deal, is the fact that we have some deferment of the application of tariffs either at the 10% or 25% level on the $300 billion plus tranche of goods that we haven't yet tariffed. And so as a consequence, if that was the case, that keeps the uncertainty around relative to the fact that talks at any moment could break down like we've seen before. But in addition to that, give one hope that there is a path toward resolution to this. So ultimately, it does what it needs to do to restore confidence in the business community that at the moment is melting and could have repercussions economically far beyond the tariffs that have already been imposed on those imports.
Ironically, Peter, if the trade talks don't go well, if there's more tariffs coming, it's probably going to make the Fed more likely to cut rates, which is also what the president wants. So right. There's, as with so many things, he has a lot of balls in the air right now. Things that are unrelated are becoming related as a result of this. And I'm sure the Fed would tell you, no, we don't make decisions in that, that simply. But that's the biggest overhang on the back half of the year, isn't it?
The Fed's knee-jerk reaction is always respond to any potential downturn in the economy is cut rates, cut rates. And they're leaning on that again. Even though the bond market has essentially already cut rates for them, we've seen a sharp drop in mortgage rates, for example. So Fed cutting rates, I don't believe, is really going to help. We're going to hear about pushing on a string a lot once they begin. But it's still their fallback position is to cut. And they are then obviously focusing on these talks because they see what's going on in manufacturing. They see what's going on with growth rates around the world. And they know they have a potential slowdown on their hands. And the worry is, what if this further spills into services? What if this starts to affect the consumer,
right.
Which, by the way, we had a consumer confidence number yesterday at a 2-year low. So they're going to have their finger on the trigger and they're going to pull it. But I do not think investors should be relying on that to save us. And that's going to separate the next rate cutting cycle from previous ones.